Steve Ricchiuto, Mizuho Securities USA, U.S. Economist. Give you a little bit of my background if you'd like. I've been doing this since the late 1970s. I've been a fixed income economist, an equity economist, the chief economist for a global investment bank. I have been an equity strategist, a bond strategist, and director of fixed income research twice. Right now, I'm just doing the U.S. economic piece of it. So a lot of what we're going to draw on today is going to be a combination of all those pieces to try to make heads or tails out of exactly what's happening. And I think from your initial question, it was like you were talking to some other people and you get a sense that they're not quite sure as to what is the underlying model that they're looking at. And I think that's fair because we're in a transition period. And you know, when you think about an automotive transmission, for example, when you're coming from first gear down to second, if you're really racing and gunning the car, you might skip second and go directly to third, especially if you're going downhill. On the other hand, if you're downshifting the car, sometimes you're going from third, you could go to second, or if you're really racing, you got to get around a hairpin turn, you're going to drop it into first gear and hope you don't blow the transmission and the engine in the process. So we're kind of in that point where people are questioning what's happening. My view is actually very different from everybody else's. I think the transition's clear, and I think it's been going on since the early 1990s, and people are just completely missing it. It's kind of like Amelia Earhart trying to find that little island out in the middle of the South Pacific, and some reason or other they never found it, and we don't know whatever happened to her. And I think people are kind of lost in that kind of environment right now because the transition that's taken place is we've gone from a world of excess demand to a world of excess supply. And that's fundamentally altered all the macroeconomics. And I think it's fundamentally altered markets and the things we have to worry about. And people aren't really sure we're there yet. And so they're looking, they're striving, they're trying to assess whether they're there. I think the data is very clear that we're there. But there's still a lot of people that are questioning. And that's why we have the turbulence we have right now in markets and a lot of the uncertainty in terms of where people want to position themselves. My view basically is the U.S. economy is stuck. We're stuck in a growth environment anywhere from 1 to 2.5% on a quarter-over-quarter basis. Year-over-year basis, we're probably between 2 and 2.25. And we've been stuck there for 5+ years. And I think we're going to remain stuck in this environment. And one of the things that concerns me the most was when Janet Yellen and company opted to raise interest rates in December, the message she transmitted was one of, the economy's already too strong. So if you're trying to figure out why the equity market's having trouble in this environment, when the chairperson of the Federal Reserve sits there and says, an economy growing at 2 to 2.25% is too strong, we're developing latent inflation pressures, and I have to make sure that doesn't happen down the pipeline, so I'm capping growth at this level. And meanwhile, corporations are sitting there with disappointing earnings, limited, if any, top-line revenue growth, and zero pricing power. You sit back and say, what am I going to do to drive up my share prices? And I think the correction we're seeing in the market since that has happened, especially since the beginning of the year, is the recognition of this. The Fed's no longer there to bail them out. So therefore, valuations have to adjust to the fundamental realities. And I think that's the critical transition. Valuations were too high given the fundamental environment that we're dealing with. People were hoping 2% growth would go to 3% and the Fed would support that. The Fed's telling you, I can't support that. And therefore, 2% growth is too high. So if valuations don't reflect very, very strong earnings going forward, then I have to chop those valuations back. And the multiple has got to come back to a realistic level somewhere between 14 and 16 times forward earnings. Just for the heck of it, put it right in the middle at 15 times. For me, what the stock market is doing in this environment is that we're still adjusting the valuation. We're still bringing the multiple down. And it's healthy to bring the multiple down. I don't think what's happening with the equity market is transmitting, oh, gee, there's an increased probability of recession, which a lot of people are starting to impute. And that was the big story of last week, people were talking about their recession probability models and things along that line. This economy is not in the position to have to worry about an outside shock putting us into a credit quality oriented recession. Could we have a small inventory correction? Yes, we've seen those already in this cycle. It doesn't matter. The economy will bounce right back up and we'll average around 2 to 2.25%. So for the equity valuations, it's all, what are my realistic forward path of earnings? And then what valuation do I attach to that? And I think what we're looking at is it's very hard to get 10% earnings, if not impossible. So the market's going to have to adjust back to a lower multiple based on the assumption that earnings are going to be somewhere between 5 and 10, not 10 plus. For me, the global decline in trade is very important. Right now, it's moved us off of a cyclical to a more staple type investment strategy, because we're looking at the impact of the global decline through the currency that's been, appreciating for the U.S. that has damaged multinational earnings capabilities. The bigger picture, though, with regard to global trade is the global trade environment's not going to be able to lift domestic economic activity, plain and simple, no matter what the currency does, because the global environment is much more at risk for recession. There are very significant credit problems that can be identified around the world that have not been addressed. In the U.S., we've addressed all of those credit problems to a significant degree. So we're somewhat immunized from any kind of credit shock. They're not. So therefore, the currency becomes the linchpin as what happens going forward. And this is where I think developments like BOJ's Kuroda surprise announcement that they're going to negative interest rates becomes important, because up until then, relative short-term interest rate differentials had been driving currencies. So because the Federal Reserve was talking about raising rates, everyone's talking about easing rates, the dollar was appreciating. Suddenly, after Kuroda, that kind of changed. And even though Janet Yellen and company may not raise interest rates, in March, they may not, people still think they're on the tightening side and Europe and Japan are on the easing side, yet the dollar actually started to go down. Now, if that transition continues, that's telling you that people are finally beginning to recognize that Japan is stuck in deflation. Europe is stuck in deflation. China's probably heading towards deflation. The country that has the strongest rate of deflation has the strongest currency. Because there's no reason to leave your currency framework. You just hold cash. You're getting a pretty strong return. And that's why the yen went from over 300s in the early 1980s down to about 80 a few years ago, because of deflation. Abe changed that perspective because everyone thought Abenomics would lead to real inflation taking place, and it hasn't. And now Kuroda, it looks to some extent like he's panicking. And to the extent that he's panicking, that could change the differential, because that's saying the people who are doing the most to eliminate deflation also happen to be the people who are probably stuck the greatest in deflation. And that means Europe's not going to be able to get out because it's trying exactly the same tools. And oh, by the way, Japan corrected most of its balance sheet problems. Europe hasn't. And oh, by the way, China hasn't. If you look at the history of the global economy, we've had significant deflation once, and that was during the Depression era. And the only reason why we got out of the Depression was because of the war. Let's be honest. So we don't know whether this is going to work. It could just wind up disintermediating banks and causing a profits recession in Japanese banks that would hamper the growth of the Japanese economy, and the Japanese economy just simply stays stuck in deflation. Deflation is a very insidious beast. We don't know how to deal with it. We know how to deal with inflation, which is why I would really rather see this Federal Reserve sit back and say, you know what, 2% inflation is too low. I want 4. 4 would allow us to have double-digit earning growth, and 4% inflation would give us a nice cushion away from deflation because we are the largest net debtor. Okay, Japan was the largest net creditor. So they've dealt with deflation in a fairly positive manner. I mean, Japan's a wealthy country. You go around, they're still hanging granite 60 stories in the air in an earthquake zone. You only do that when you're wealthy, right? I mean, it's an incredible, Tokyo and the Japanese environment is incredible living standards. So you see that come through. We, on the other hand, are more of a concern because we are a net debtor. Now, to get back to the negative interest rate story, we don't know how that's going to work. Theory says one thing, but this theory also said the QEs should have worked as well. The problem with theory is they're built on post-war excess demand models because prior to the war, we didn't have great data. So in the post-war excess demand environment, we had V-shaped recessions because nothing was fundamentally wrong. The economy got too hot for itself. Federal Reserve tightened interest rates. The economy slowed. When the Federal Reserve eased up, the economy came roaring back because there was excess demand. The last 3 business cycles here have been credit cycles. 1990 was all about the thrift destruction. The 2001 was really not about the bursting of the technology bubble. It was the destruction of the commercial paper market when California's utility Calpine blew up. And this latest one is the mother of all housing downturns that took household balance sheets down with it. So when you look at these particular environments and you contrast it to where we are now, we got through the first 2 okay because the global economy was just transitioning to a world of excess supply. Now we are in it. And the linchpin that pushed us over the top was China's desire to thumb its nose at the rest of the world, sort of expression. China decided it was going to prove to the rest of the world it was different. It didn't have to succumb to the pressures that the rest of the world came from. And China doubled down on investments, and they were the same investments they already had excess capacity in. And now they're dealing with a lot of bad loans based on those excess investments. And they haven't corrected the problem. The business cycle, I could see where that can come from. We could have a bank-related slowdown in commercial real estate. I certainly think in certain markets, commercial real estate is overbuilt. It's been a huge support underlying the economy. That had happened. We cleaned that out in 6 months. It's one of those things where you're in it and you're out of it before you even know you're in it. The automobile industry, again, they have incredible inventory of product. They also have been pumping cars out. They're selling cars at 0 down again, 0 interest rate financing because the curve is flat, and they're being able to pull sales forward. At some point, you pull all the sales forward. There is none. You have a little bit of a problem. You have an inventory correction in autos that produces 1, maybe 2 quarters of negative GDP. Okay, so what? It's not a credit downturn. It's not a major contraction. It's simply think about it. Japan has had these rolling recessions for 25 years, primarily because of the same thing. They've been improving their balance sheets throughout that entire period. And therefore, the recessions don't get deep and broad. What everyone's panicked about is, will the next one be a big and broad recession? And the answer is, and they're all saying, well, because we're so many years into this cycle, it's long in the tooth. Well, business cycles being long in the tooth really matter where balance sheets are. And to be honest with you, after 7+ years into this cycle, we've just repaired balance sheets. So this cycle could go on another 7 to 10 years. It could be the longest in history. Could you have 1 or 2 quarters of negative GDP in the process? Yes, you will. That's guaranteed. But they're not going to be systemic, which is what markets are really paranoid about. When I think about the energy space in particular and the drag that's coming from the energy space, you have to ask yourself a question, is this going to propagate out from the banking industry to other industries in the economy? And there are 2 things that I think you have to consider here. One is bank risk aversion. Okay, banks are being very risk adverse in terms of who they lend money to, okay, because they've gotten burned so badly in lending money to households. By the same token, banks are sitting here, and from the other side of the risk aversion, because they've just repaired their non-performing loans, because they've just got their coverage ratios back to comfortable levels. Do banks want to go out and start to squeeze all those energy-related lenders, or would they rather restructure those debts so they stay performing and they don't hit their earnings? So the other side of risk aversion is banks have it in their own interest to extend the credit and to keep the credit available. Not necessarily extend new credit, but not pull back the credit from the energy investments that are already there. And I think when you're seeing what's happened with energy prices, we've bottomed out at around $30 a barrel, which is where we should be. And a lot of the estimates are that a lot of the fracking numbers come in around $34 a barrel. So we're really not in a major energy squeeze. We don't have huge pipeline projects that are sitting there. These are wells that you turn them on, you turn them off. This is equipment that has long shelf life. It doesn't dissipate. It doesn't deteriorate over time that quickly. It's equipment that could come on anytime energy prices move up. Anytime energy prices move down, you can shut it down. And we're going to stabilize around $30 a barrel. And banks are comfortable having dealt with that this is a viable alternative. I think the same thing's true somewhat in the commercial real estate market. I don't think they're going to restrict the flow of credit based on a couple of non-performing commercial real estate projects. They'll extend those from the risk aversion standpoint. They don't want to take the hit to their earnings. So there's two sides of the risk aversion trade that come in here that I think are kind of balancing each other out. Banks aren't adding to the business cycle. Banks aren't deteriorating from the business cycle because of the position the government has put the banks in. And because the banks have just finally, in the third quarter of last year, gotten back to a non-performing loan balance level that they feel comfortable with and gotten back to a coverage ratio, which are reserves against their non-performing loans that they feel comfortable with. It's taken them until the third quarter of last year to get there. They're not going to go out and erode that rapidly. And they have a lot more capital. So they have the ability to extend this cycle. When I look at the dollar situation and I look at the relative growth differentials between the U.S. and the relative interest rate differentials between the U.S. and everybody else, you can make a very strong argument that relative growth and relative short-term interest rate differentials argue for a stronger dollar. Except when the transition develops that we accept that everybody else has gone into deflation. Once someone goes into deflation, the drivers of the currency shift from being relative growth or relative real interest rates, because they're somewhat synonymous, to purchasing power parity. And if I'm a Japanese investor and I'm convinced Abe has failed and Japan is sliding back into deflation, I have no incentive to move my money outside of Japan because my purchasing power is rising all the time by leaving it in Japan. In fact, as a U.S. investor facing minimal interest rates and the potential that purchasing power parity takes control of the currency, I may move money into Japan to get that benefit as well because the currency will be going up, which is exactly what happened in Japan in the 1980s when they went from 300 down to 80s through to early 2000. And the argument there basically was purchasing power parity. Deflation drove the currency stronger, right against amplified the deflationary pressures, which is the concern that I have so badly about deflation. Once you get into deflation, it's not just the deflation mentality domestically, it's the impact that has on your currency that squeezes your export capabilities, which is why Japan spent most of the 90s and the early part of 2000 getting production out of Japan because the currency was killing them. And that's the risk factor. That's why I look at developments like Kuroda's announcement 2 weeks ago, 2.5+ weeks ago, and say, this may have been a game changer. And I say that because Japan is a consensus society. Let's be honest, things typically don't happen in Japan unless they've been well vetted. And I mean well vetted. Everyone knows it. Everyone's talked about it. Everyone's had a chance to weigh in on it. Everybody can agree to disagree or agree to agree. They get it all out in the open, then it happens. Nobody cares. This came out of the blue. The banks were learning about what this negative interest rate policy meant through the marketplace, through the press. Never happened before in modern Japanese times. And I think we may discover the same thing happens in Europe when Draghi makes his interest rate decision later this year, in about 4 weeks' time. The ECB comes in and they wind up saying, we're going to do a massive cut in the interest rate to negative territory. Maybe we go another 30 basis points, a pretty big move all at one time. And guess what? If the euro doesn't go down on that, then Europe is sunk. Then people are saying deflation's in Europe. I think when you're looking from an asset allocation from a top-down standpoint, my recommendation going into the year was bonds were going to outperform stocks. And that has proven so far to be correct. Let's see what happens over the balance of the year. I mean, I certainly realize we're only in February. We've got 10 plus more months to go. A lot of things can happen. But if the scenario unfolds the way I think it will, the adjustment in equities is not complete. And the adjustment in bonds is not complete. Because yes, if you've got global deflationary pressures And we're only stemming the tide against that through our currency going lower. Then you're sitting here saying, okay, what's wrong with treasuries going through 1.5% on the 10-year? Probably not a bad thing. And so, yeah, you could have additional price appreciation. Now, here becomes the interesting thing. As treasuries rally, what happens to spreads, and do we start to misread the widening spread environment as a credit story? And this is what I think was happening a week ago. What was happening was treasuries were rallying. We got all the way down to 1.5% on the 10-year now. We're now back to around 1.75. So we've moved 25 basis points. The spreads have collapsed. Everyone feels better. Spreads widened out because treasuries are rallying. Everyone goes, oh, there's a problem. It's not a problem. Corporate balance sheets are healthy. The all-in cost of capital of corporations didn't go up. They just weren't keep pace with the treasury. That's a very, very different thing than the all-in cost of capital rising to corporates. In addition, we also have to realize the new regulatory framework has limited the dealer community's ability to do clearing trades, i.e. if a customer wants to get out of one bond, get into another. The street is not in the position it was before to take down those positions. So clients have to be willing to accept a bigger markdown to reduce their position. And in an environment where everyone has been overweight credit, any whiff that credit is deteriorating means people are going to be more sensitive to their credit positions. And if you have to mark it down in a very illiquid environment, we know what happens temporarily. It creates great opportunities for people who have cash to bid. And that's what I think will actually happen in this environment. I think those opportunities should be exploited in the bond market, much more so than in the equity market. Well, if I'm right on the currency story, then I honestly believe there will be a transition that takes place sometime this year. And it really does depend on the currency story. It depends on where the dollar yen goes, where the dollar euro goes, where DXY goes, where the trade weighted value of the dollar goes, where the dollar yuan goes. If the dollar starts to devalue against all these things and you wind up going down on a bucket standpoint, even just very, very gradually, then there'll be a transition that takes place out of the more conservative staple type products, the defensive trades, into the more aggressive trades, because some U.S. multinationals will start to do better than that. Some corporate tech companies will start to do better in that kind of global environment. Even though global competition will be tough and global pressures will be tough for them, they will at least have the benefit of the currency on their side. And that's the transition I'm waiting for. And that will be the real transition that says, hey, the adjustment process in equities is really over. And that's the multiple we're probably going to be stuck with. Now we can start playing what sectors within the equity market we think will outperform. So that's the framework. That's how it hangs together. If you're really looking at trigger mechanisms over the next week or so, look at how the currency behaves on durable goods. Look at how the currency behaves on the ISM numbers. Look at how the currency behaves on payroll employment. If all those numbers come in a little bit better than expected, kind of like that retail sales number did, and I think they will, kind of like the Empire State number did today. And I think they will come in a little better than expected. If the dollar doesn't go up, then by the time you get to Draghi, if Draghi cuts and the euro doesn't go down, then the transition is happening. Then we wait for the Fed's move later in March, and we'll see if markets have stabilized, even though markets have said the Fed's not going to raise rates again this year. We've seen since the second half of last year, we go from all or nothing at all. They're either raising it by 100 basis points or they're doing nothing and the market's discounting. The market last week went to they're doing nothing. Some people talking about the Fed easing, which makes no sense at all. And they could easily shift back to, everything's stabilized. The payroll employment numbers are stronger. The unemployment rate came in a little bit lower than expected. Payrolls were pretty strong. Fed could move in March. And then if that doesn't drive the dollar stronger, then the transition is fully complete. My view is very dependent on the currency. And if I'm wrong and the euro actually goes down and the yen actually goes down, then we're just stuck where we have been. And the equity adjustment will still happen, but I don't have the transition to a cyclical trade that unfolds. And I may cut the adjustment in the multiple a little bit short. So this is, to me, the best case scenario is that I find a multiple floor and I find an ability to go into the cyclicals, and the outperformance of bonds over equities will be somewhat smaller. The worst case scenario is the outperformance of bonds over equities will be that much greater because I stay in the staples and I have a little bit more of a multiple contraction to come through. But this is not a crisis environment by any stretch of the imagination. And I guess I can kind of elaborate on that. We kind of talked about banks, the non-performing loan balance and their coverage ratio. What is it about the economy that makes me feel so comfortable about its ability to withstand shock? And the answer is balance sheets. If you look at the household sector balance sheet and you look at the non-financial corporate sector balance sheet, because we've covered the financials basically in the banks, balance sheets really are a function of three fatal sins of leverage. And this is where my Roman Catholic upbringing comes in. If you have one or two of them, you're in credit purgatory. None, you're in credit heaven. All three of them, you're in credit hell. What are the three sins? You levered a lot, you're levered short, and you're paying a heck of a lot of money to roll it over. Eventually, somebody says, I'm not lending to you. You get into a cash flow squeeze, and you go bankrupt. That's simple. When I look at the household sector, we've delevered a lot. Our debt burdens are at the lowest levels they've ever been. Our duration has gotten shorter. But it's gotten shorter because we've taken down a hell of a lot of auto leases as opposed to mortgages. And auto leases and auto borrowing have a shorter duration than mortgages. But we're still at a very comfortable leverage level in terms of that duration. And those loans are fixed term. They're not floating. So I feel comfortable that the household balance sheet has maybe one, if not less than one, sin of leverage. It's in purgatory at worst. Non-financial corporate sector, exactly the same thing. They've levered up a lot. They've levered up to buy back shares. Okay? But as soon as they stop buying back shares because they realize they're not getting paid to do it anymore by an equity market, then they stop buying back the shares, the leverage starts to come off. By the way, they're still levered very, very long, so they don't have to roll over the leverage. And again, they're almost at record levels in terms of the low level of their financial obligations ratios. So again, at most, they have one sin of leverage. Prior to each of the three crises we've had, credit stories we've had since 1990, we have had one industry at least that was in credit hell. One sector, I should say, at least that was in credit hell when it happened. And that's why the collapse in credit ensued. When I think about the banking industry in general against this backdrop, you certainly have to start to consider the European banking industry. And to some extent, you can't completely discount the Japanese banking industry because, the curve environment is really doing damage to the profitability of regional banks. But again, they're still fairly healthy from a capital standpoint. European banks have some specific problems. And we've seen that manifest itself in the last couple of days with the rumors over Deutsche Bank, the rumors over Credit Suisse. And these are publicly available, so they're easy to discuss about. And there's been rumors about other institutions that come down the pipeline, some of the Italian institutions, some of the Spanish institutions. And yeah, they are real regional problems. But do they transmit back onto American shore? That's the difference. And the answer for me is, we know all the exposure to these institutions. Okay, we have gone over and over since the European sovereign debt crisis, our exposure to these institutions. So our exposure is somewhat known. One of the biggest problems with a shock is when you don't know the shock because you don't know your exposure. And that leads to the panic syndrome. We have vetted the energy. We have vetted the non-residential real estate story. We have vetted European bank problems. Every U.S. bank knows its exposure to all of these problems. And they have somewhat reserved against it or hedged against it or restructured against it. So when they hit, they have less impact. Do they say we're more likely to have an economy that grows at 1.5% than 2.5%? Yes. Are they going to put us in negative GDP? The answer is no. If I am a fully currency hedged investor, the answer is I would want to be. My answer on global asset allocation is I would want to be in the US. If I'm taking the currency into perspective, I have to figure out how much I could lose if the deflation story takes over. And that's why I think this is such a pivotal period. This is something I've been waiting for about 2.5 years. I've been waiting to see a break in that real interest rate, real growth story on the currency. And it started to come through after Corona. Took a pause late last week. Sometimes these things don't go in straight lines, so taking a pause is actually a pretty good thing. I've got to see now whether the rest of the information comes through. If the rest of the information doesn't come through, then that's exactly right. Then the U.S. story does look better. Then you do think about more of the downturn in the multiple getting cut short because foreign money comes in. Is that as healthy as letting the multiple fully adjust and then transiting from staples to cyclicals? I'd rather transit from staples to cyclicals based on a currency immunization than from the fact that we're still fighting, because that means we still have the ability to import deflation domestically. And that was why I never wanted the Fed to raise rates, because importing deflation is a big problem for us because we are the largest net debtor. You want to look at the impact between a debtor and a creditor, just look at Europe. Right? The Germans, a little deflation, what's the problem? The Italians, a little deflation, I'm dead. That's the difference. And we are the world's largest net debtor. I've often been asked the question about what do I think the Fed is going to do going forward? Will they raise rates again? Will they eventually cut interest rates? Do they go back to the zero baseline? I think this Fed wants to raise rates again. I think much like Trichet in 2011, who did it once and then did it a second time to prove he meant to do it, this Fed kind of wants to do that as well. It was a mistake for Trichet. The first rate hike was obviously a mistake for these guys. But I don't think they're willing to transit back to the zero very easily, nor do I think they're going to have to do that. So I think the onus is on the economy to prove to them that there is no domestic inflation bias and that they have a greater deflation risk. And you're not going to get that in an environment where you have the currency doing what it has been doing very recently. So I think the Federal Reserve right now is still in the mindset to raise rates. They just need the excuse. For me, that the implications of that are that the yield curve can continue to flatten going forward. The question is, does it flatten from the long end because we import deflation? And does it flatten from the short end because the Fed makes a policy mistake? I think it can actually happen from both sides, which is the most scary part about it, which is why I think when you look at bank earnings right now and the reason for not wanting to be in that cyclical trade, it's primarily because of that yield curve environment. It doesn't induce bank profitability in any way, shape, or form. Well, the Steve Ricchiuto pension fund actually is very, very defensive. I mean, I'm old. I only have 15% of my money in S&P 500 and index fund right now. The rest of it is in too big to fail preferreds and commercial real estate preferreds where they are actually reducing leverage. And there are a few of those REITs out there. I do have some healthcare related REITs as well. I'm in the preferred side of this as opposed to the bond side of this because I will get destroyed if I try to do a bid ask. I'm an odd lot, right? I'm an economist on Wall Street. I'm not a hedge fund guy, right? So I mean, I'm doing odd lots. I'll get destroyed on both sides of that trade. But in a preferred, I can get in and out on the screws. So I just do the preferreds, which are basically fixed income surrogates for me. Within the equity portfolio, I'm in the S&P 500 fund right now because I think everything is just defensive. And when you look at where the market cap weighting has gone, it's gone more towards the defensives. So there's no reason to pick a specific industry. I just buy the S&P 500 right now. I am waiting to transit out and then go more cyclical. And if I do that, yes, I will then break down my S&P 500, increase my equity weighting probably to 30%, and spread it out into different ETFs. I buy ETFs simply because what I do for a living, I can buy and sell ETFs without going through compliance hurdles. If I have to go and pick a particular stock, there's a compliance issue. So rather than having to do with that, I just do the easiest, like a lot of people do these days. I'll just buy the ETFs. And I'll transit more from the defensives, which where the S&P is biased right now, into the cyclicals. So right now, if I was to tell somebody which ETFs in particular on a sector basis to buy, I'd be utilities, I'd be REITs, I'd be healthcare, I'd be consumer staples. Okay, I'd be on the shorts on every one of those sides, the opposite side. The transition I would make would be to reverse that trade completely. go into the multinationals, go into the tech companies, go into the banks more aggressively. I would not go into consumer discretionary because that's dominated by the autos, and the auto space itself worries me fundamentally because I think they are pulling a lot of sales forward, and I think they have the greatest risk for an inventory correction, and I don't like the earnings. So I would leave consumer discretionary out of that. From a timing perspective, my view is basically that it's a function of what Draghi does in March and how the market behaves on the backdrop of that, and what the Fed does in March and how the market behaves on that. So we have a couple more weeks to go before the transitions take place. And I would be very early on in that transition. If the currency goes down, if the dollar goes down and Draghi has cut rates, the dollar goes down and let's say the Fed would or actually raise rates and the dollar still went down, I'd be like, this is the clearest signal in the world the transition's complete.